our third lecture out of the 6-week series. And today we're going to go over some more technical, or actually start technical analysis and go over some more chart patterns that we were getting into last week.
Tight.
So first, taking a look at the different candlestick patterns, you'll notice that a lot of these patterns are kind of repetitive. There might be a little addition of one more candle that might be a little bit more specific, but it also might be a little bit more telling of the pattern that's about to occur, meaning like whether there's going to be an upwards direction or a downwards direction. But overall, you shouldn't be too worried about memorizing these names. You should just kind of have a hang of understanding what these candlesticks indicate. So last week we kind of went over some of the basic candlestick patterns, shaven bottom, shaven head, as well as the dark cloud cover and the bullish piercing pattern. So these candlestick patterns only consisted of one body, like one candlestick, or two candlesticks. But what you'll notice in a lot of different candlestick diagrams is that there are more than two, sometimes more than three candlesticks that can contribute to a pattern. And as I said, when the more candlesticks that are sort of in each pattern, you'll see that the sort of outcome is more specific, and rather than having like a more broad possibility of going upwards or downwards, you might see that same pattern. It might not occur as much, but when it does, there's a higher sort of guarantee that the upwards or downwards movement will occur after that. So yeah, if you could just type in the URL at the end of the lecture, I'll go back to the slide. You could watch the lecture from last week, and that kind of just goes over a little bit more of the even more basic parts of candlestick analysis. All right, so we'll just go over a few candlestick patterns. So the first one is a very basic one. It's called a hammer. So this one is basically just one candlestick. So it's not dependent on multiple, or there being multiple candlestick bodies. This one, as you can see, it kind of just looks like a hammer, right? There's a kind of small body, but that's what is that? The closing price is at the very high during that time interval, while the opening price is at around the 75% mark of the from the low to high. So if you weren't here last week, the low of that time interval, so the price low, is indicated by the bottom part of the stick. So you see like the green body, the bottom part of that stick under the body is the low of that time interval. So each candlestick might represent 5 minutes, sometimes 1 day. If you're like a swing trader, you might look at this for in terms of hours. But anyways, this bottom part of the stick is the the very low during that time interval, and the top part of the stick, you might not see it since it's the same as the closing price. That's the high during that interval. So whenever you see a hammer, it might be a possible indication that the downtrend has ended, and then that an uptrend will occur from that point. So this is not always the case. You might just see this during some sort of price congestion, which we'll get into. But usually if you see a green body such as this with the closing price at the high during that time interval, it's likely suggesting an uptrend after that. Next is the bullish engulfing pattern. So the bullish engulfing pattern this time consists of two candlesticks. So the other one, the hammer, only consisted of one. But as I said, with the more candlesticks you're adding, there's a higher possibility that the pattern or that the indicated pattern, will follow the trend that was usually associated with the pattern. So since there's two, there's a higher possibility that the suggested uptrend after will occur. So in order for the bullish engulfing pattern to qualify as one, you need a red body at the midpoint for the first candle, and the second candle should be a strong green body with perhaps maybe a closing price near the high of that time interval, but also just having a opening price towards the same closing price as the first body. So what does this indicate? Yeah, this indicates a potential change in direction upwards. And also, as always, when you're looking at candlestick patterns, this is not always a 100% indication that there will be a change in direction. Okay, so before we get really just all over candlesticks. We should all realize that realizing or recognizing these patterns takes a lot of practice. So just looking at past graphs, just looking at zooming in and specific time intervals, if you get really zoomed in into like maybe just a few candlesticks, you'll kind of start to see these patterns coming up. I mean, there's a huge list of patterns, maybe like 40 or 50 are regularly used by day trade or high frequency traders. But do not try to figure out or these patterns by memorizing them. Just try to think behind the logic of each pattern, because remember, the candlesticks are simply just indicators of lows, highs, opens, and close for the price during each time interval that the candlestick represents. So candlesticks are not some sort of, like archaic representation of something that's not feasible. It's something that it's a literal price. So if you were to just look at a line chart, I'm sure that you guys would all be comfortable with knowing what the price was indicated by that line at each specific time. So yeah, so just bottom line, don't try to memorize these patterns. Just try to think or actually look at past graphs. That will help you the most. Just look at past graphs, kind of see how the candlestick kind of led into the next and where the trends were made based on um, actually looking at some of the candlestick charts, or not the charts, the diagrams of each pattern. You'll start to see those matching up with reality. All right, so this one's called Three White Soldiers, or since the traditional green candlesticks were white, this time, well, now obviously they're green. So like the three green soldiers, this indicates a very strong bullish or upwards trend. So if you see these three, it might suggest that the buyers are taking over, so the bullish investors, and that a stronger uptrend might occur after that. However, as you can see with the red candle right after, it also might suggest that shorters come in, or the bearish investors. These people have like a less optimistic view on the price movement, and since price is determined by supply and demand, as we covered, um, more supply, less demand would cause a red candle, but lower supply and high demand would increase price, right? So obviously, if we're just thinking about like any consumer item, if there's low supply of it but high demand for it, obviously the price will go up. Yeah, so the same case for trading, you can see that there's a very strong um, demand movement here. I mean, we could always just think of it in terms of demand, right? So it's not really just gonna turn off right away. You usually don't see a very strong downtrend after an uptrend such as this, unless there is some um, sort of like information in the news, right? So you're not gonna just see random price movements based off of nothing. Usually that's based off of speculation, right? You're not gonna see price movements based off of the, oh, this is a good price to sell, and then suddenly the entire share price declines. So you're not going to see uptrends solely based on like linear movements. You're going to see them in curves. You're going to see a whole variety of price movement. So what you have to recognize is that even as you're kind of looking at these, sometimes a lot of people forget that it's based off of supply and demand. You always have to remember it's supply and demand. It's not just some random arbitrary decision that's kind of moving the price. So the next one kind of looks like a hammer, except this time it's red. So this kind of appears after an uptrend. This, of course, as you can see in the candlesticks after, it suggests that a downtrend may occur. So, well, what does this mean? So when you see the long stick under the red body, that shows that the closing price is actually not that close to the low during that time interval. So why would this indicate like a strong downwards trend after? So if you kind of studied candlesticks before, you would know that you would note that the opening price is at actually the high during that time interval, and at the close is somewhere at the 75% mark. And just how we saw in the green candle, that was a hammer, that also represented a change in direction. Except this time, with the low price being much lower than the closing price, it might suggest that the bearish investors are actually trying to get out of their positions, right? They're really trying to sell. They're hard selling. So that once the bears, they see that candle, they all might start to sell, or even the bulls, or the bullish investors. Once they see that first red candle after a strong uptrend, they might think, oh, the share price is going to fall. I'm going to sell right now. And like I said, with more supply from selling, the price is going to decrease, right? So we should always think about cause and effect. If I am 100 investors, if I represent 100 investors, and I see this red candle after a strong uptrend, I'm probably going to think to myself, oh, I, as in 100 investors, am probably going to sell my shares because I see a downtrend coming. So this is all based off of human emotion. Okay, so candlesticks do not just represent random robotic movements. This represents a lot of emotion. That's kind of why you see during downtrends why there's not almost immediately an uptrend right after, because most people, when they see the share price falling, they panic. So yeah, of course, panicking is a human emotion. So when they see this first red candle, this with a long stick body, they're gonna think to themselves, oh, okay, share price is definitely gonna fall, and that's exactly what's indicated by the following what is that? The following pattern right after. Um, yeah, so just when you're looking at candlesticks, just always remember supply and demand, and sort of if you were any individual investor, what would you do if you saw that pattern? So obviously, if you were an investor, as I said, you would probably sell your shares at this point in time if you see a strong uptrend and then suddenly a sort of minimal downtrend, except at that during that time interval, there was actually quite a pretty low in terms of the long stick body. All right, so this next one, as you can see, the small body in the middle of the three candles is quite small. A lot of people call these doji stars, which we're not going to really get into. Those are kind of confusing. Um, but as you can see in the first one, in the first candle of this pattern, there's the opening and close are at the low and high respectively, right? So during that time interval, there was huge volatility or change in volume, meaning that the opening price was at the very low and the closing price was at the very high during that time interval. But in contrast, the next candle shows that there was not that much increase. So when you kind of see that signal that there was not that much increase, that might be a signal that buyers and sellers might be selling and buying at the same amount, right? Because remember, the share price is determined by supply and demand. So at this point, since there's not that much change, supply and demand might be kind of equal, right? Like sellers might be equating the same amount of shares as the buyers. So right after that, that actually might indicate a downwards trend. The thing is, which I'm not sure if I have a slide for this as well, if you see the exact opposite, if you see very strong downtrend and then suddenly a little bit of a downtrend right after, or like a very little red body, it actually might suggest a change in direction upwards. Yeah, so don't worry about the names, which is exactly why I didn't include the names of these. Just kind of recognize what each not symbol, what each sort of combination of candlesticks represents, and what that might suggest after considering human emotions and supply and demand. Okay. Now we're gonna go a little bit into technical analysis. So technical analysis, as I'll explain in the next slide, it's sort of a broad subject. Even if you go to like Wikipedia, you search up technical analysis, there's like a variety of ways in which you can conduct it. So technical analysis is based off of indicators. So people who use technical analysis, if you guys remember from the first lecture, technical analysis is used by short-term traders, no, typically not by investors. Investors usually look for qualitative information, as in they look for information regarding who the board of directors is, like how much experience the managerial directors have, even just like the revenue income statements, right? That's what they care about. For traders, though, like for people who are going to trade frequently, maybe buy and sell during the same day or the same week, even up to like 1 year, during the time interval of 1 year, if they're going to buy and sell that quickly, there's probably not that much that's going to change within the company. I mean, obviously, unless there's like some breaking news, which is quite common with Tesla these days. Yeah, so technical analysis is used mostly by traders, And as we're going to see, there's a lot of different ways in just price and volume can indicate things, right? So you might think to yourself that price and volume are, that's it. They're just flat values, and that you'll be able to tell everything from those. But as you can see from candlesticks, candlesticks were created by humans. They're not just like arbitrary like meanings of price and volume. So technical analysis is just a combination of indicators that are going to help you decide when to like enter a trade, when to sell your position, or even how many shares to buy. Yeah, so why technical analysis? So as I said, technical analysis is what financial analysts use to define patterns in market data. And based off of this data, they're going to make predictions that will help decide whether they should enter a position or leave it, find entry and exit points for when they're going to buy and sell, visualize sort of the price and volatility, and also find trends, which is what we were kind of doing with the candlesticks. So yeah, the candlesticks could count as a part of technical analysis, but what you will find is that simply using candlesticks will not help you, or it will help you, but you need a sort of stack technical analysis or TA on top of it if you want to find the best entry and exit points. Because as you saw in all the candlestick examples, it kind of showed the downtrend or the uptrend right after the pattern. So there's a sort of hindsight bias in that, meaning that, oh, of course the price is going to go down after that pattern, right? But you don't know in reality, right? So if you see that pattern, you don't really know if it was just a sign of congestive price movement, or if it was a real indicator that there was going to be a change in direction upwards or downwards as suggested usually by that pattern. Yeah, so technical analysis overall, just to find entry and exit points, visualize price and volatility, and to find trends. So yeah, technical analysis is simply based on the foundation that past trading activity and price changes are indicative of future movements. So technical analysis is simply based on the past, but as always, the past is not always indicative of the future. So technical analysts, they have a really firm and strong belief that history repeats itself. So like if you were to see one pattern in the past and you're almost along the lines exactly of that same pattern, you're likely to see the same thing. All right, so the first sort of technical analysis strategy that we'll go over is the moving average. The moving average is probably the most used technical analysis strategy. As you can see in this blue line indicated in this chart, that is the moving average line. So like what determines the moving average line? The moving average line is it's a smooth line, right? And the reason it's smooth is that it's the average price for like the past, in this example, for the past 200 days. So that each point on that line is representing the average price combined over the past 200 days. So if you could see the moving average graph going up, it kind of indicates a long-term uptrend. If you, what is that? And the same vice versa. So as you can see, it says MA200 under the GE daily, the General Electric, right? So if you see MA200, that means this line represents for each point the average share price over the past 200 days. So if you can kind of see it going up, you'll realize, as I said, that that's an uptrend. So like, why is this important? I mean, it's pretty obvious from the candlesticks that it's an uptrend. But what you will see is that at each intersection point between the moving average line and the candlestick graph, those are actually the best entry points. So just take a look at the first blue arrow. If you were to buy at that point, and we're going to go into selling later, and sell at the high before the second blue arrow, that would have been the best entry point. So what we're going to find continuously is that in the same for the second arrow, the moving average line intersected the candlestick graph at another very good entry point. See, that was the low during that perhaps like 2-month time interval. And same with the third. That's almost at the exact bottom of the share price during that time interval. Same with the fourth, and same with the fifth. So what we're going to find with moving averages is that when you find an intersection point between the moving average line and the candlestick graph, that is very indicative of a very good entry point. So when you're changing the interval by which the moving average is sort of aggregating all its data, so maybe not 200 days, but 100 days, you're going to find more entry points, but they might be lower quality per se. So kind of like, what does this look like? If you were to turn the moving average to 100 days, it would move a lot more, and it would be closer to the candlesticks because what is that, representing an average price that's closer to the present price. So yeah, setting the moving average to 200 days is very common. It's a very common use of the moving average, but if you want to use what is that, moving averages for a lot more short-term trading, as in like you're trading like every like 5 minutes, using a moving average might not always be the best because the moving average is indicative of like the past like multiple hundred days sometimes. So you're not really going to see the moving average contribute a lot in terms of meaning for the current price. So yeah, just remember that when the moving average graph or line intersects the candlestick graph, that might be indicative of a very good entry point. Yeah. So as I said, the intersection points are a good indication of an entry point, but also they could actually be a good indication of an exit point. So exit points not necessarily meaning just you already have shares and you want to sell them. It could also mean that you don't have shares and you want to short them. So if you're kind of familiar with finance, what is that? You would recall that shorting is to sort of borrow shares, and so sell shares that you don't have, and then when the price goes down, you buy back those shares for a lower price. So where's the profit coming from? So basically, when you're selling those shares at a higher price, you're making all that money because you're literally selling those shares. You're making that money, and then if you're able to buy them for much less, then you made a profit, right? Because you spent some of that money that you got from selling those shares that you technically did not have, and you're buying them back for a much cheaper price, right? So just kind of think of it this way. Let's say that you were returning an item, right? So you were returning an item to Walmart, right? So you would get your full $200 back. And then suddenly the item price was declined to 150. Well, you returned it for 200 and now it's only worth 150. You can go back and get it for 150. And if you were to compare yourself to the scenario in which you kept that returned item instead of returning it, you made $50 on top of it. Well, technically you saved it, but you see what I mean. So when you're thinking about this in terms of shares, when you're shorting a position, it means that you're selling shares that you don't have, but you're sort of predicting that the price will drop so that you could buy those shares back at a lower price. So the same thing with the moving average graph here. Whenever it intersects the candlestick graph, or if it's at a high or a low, that's very good. That's a very good indication of whether it's a good exit or entry point. So when you're shorting, that's kind of an exit point, even though hypothetically it's an entry point since what is that? You're going negative in your position. But yeah, it's always a good indication to use, or it's always a good way to sort of find entry and exit price using the moving average. So if you can see there's a red and blue line, but the red and blue line kind of represent different moving averages. So like I said, you could change the time interval that each moving average line covers. So I believe the red moving average is monitoring a lower amount or a shorter amount of time, while the blue one is not. So because of that, the red line moves a lot easier and it moves earlier than the blue line, as you can see, since it's not monitoring as long a time as the blue, right? So if you're taking an average of any amount of numbers, the more numbers you add, the less sort of significance they have towards the overall value of the average. And oh yeah, also when you're looking at long, that simply means just buying shares, right? You're not shorting. It's kind of weird, short and long are opposites, but literally, when you're shorting it, you're selling shares that you don't have, and you want to buy them back at a lower price. For long, you're buying shares at a lower price, hoping that the price will increase so that you can sell those shares at a higher price. So basically, shorting and going long on a position are basically opposites. Yeah. So when you shorten, as I said, when you shorten the interval that the moving average monitors, you'll find more opportunities for a trade. They're like much higher frequency, but they'll be lower quality. So as you can see, if you were to use a 200-day moving average as indicated by the blue/purple line, you wouldn't actually have any intersection points besides the first one and the last one that the green had. But if you were to shorten the time interval that the moving average sort of covered, such as the green one or the green one or the orange one, you will actually have a lot more intersection points, meaning more opportunities for you to enter a trade or to enter to enter a position or leave it. Um, yeah, so one thing about trading is that you have to know when you want to enter a trade or when not to. Um, what we went over in the first lecture was to stay out of sideways markets, meaning you're not really sure whether the price is moving up or down. Here, it's really clear that there's an uptrend, considering that the moving average is consistently moving up. Um, but yeah, so just shorten intervals if you want to have more opportunities to enter a position. But if you want higher quality trades, meaning that you're more certain that the moving average intersection is a good entry point, you should lengthen that interval that the moving average is monitoring so that you will have higher quality trades. All right. So the next one is kind of unrelated from the moving average is the average true range. This is another method of technical analysis. So while what is that? The average true range, it only monitors price volatility, while the moving average, it just measures price. So it's not measuring how much price is changing in that time interval. It's just an aggregate, basically combined addition of all the prices in the past, for example, 200 days, and averaging those out. But the average true range indicates how much price volatility is. So like how much is the price moving? Usually you can just kind of tell that by looking at the graph, like how much is it jumping up and down, how choppy is it. But the average true range is literally a visualization of how much share price deviates during that time. So as you can kind of monitor as moving along the candlestick graph, as there's higher changes, the ATR or the average true range graph right under it is going a lot higher. So kind of between May and September, there was not that much movement. It's kind of a sideways movement with kind of a quiet bullish uptrend, but there was not that much movement up or down. The candles were very short, and because of that, as you can see in the average true range, it was very low. But as you move into December or January, as indicated by 19, you'll see that the average true range reached its high, meaning that there was the most price volatility. The price was moving up very quickly or down very quickly. Um, so the average true range doesn't indicate whether the share price is moving down or up. It just indicates that it's changing very rapidly. Um, so when you're looking at the average true range, that should be very indicative of whether you should be entering that trade or not, because you don't want to be too risky, right? If it's moving up and down that much and you're looking to go in for a short-term trade, you don't know if you're going to be on the wrong side of the up or down trend, right? Like you might be in December thinking, oh, it's going to go down right away. And you might be right, except right after it goes up a little bit and then it goes back down. So it's a very complicated sort of approach to trade using an average true range individually, but that's also why you would stack sort of moving averages techniques as well. So not there are no technical analysis techniques that like work by themselves when you're determining entry point or how many shares you want to buy. You have to combine these methods if you want to have sort of the best quality trades. And when I'm mentioning quality, I'm not saying quality as in you're making money or not. I'm saying quality as in um, you're finding like the best appropriate, the most likelihood of having the best entry point. So like my entry point was at the very low, versus just choosing a price point at the middle of an uptrend, right? You always want to make the most amount of money possible. Um, so you can kind of interpret it in normal scenarios as greed, right? Just trying to find the best entry point, get the most amount of money. But really, you're just trying to maximize like the profits. Like I like to think of profits as points rather than dollars, because when you're thinking of it as dollars, you might have a different trading approach when you're just trying to make money quickly. As a beginner trader, you just want to make sure you're having the best quality trades. A lot of people, they just look at the news, they watch Jim Cramer. I'm not sure if you guys are familiar with him, but they just hear a stock and then they're like, oh, I'll buy that stock because this big shot guy is talking about it. No, but you want the highest quality trades. So use technical analysis, use candlestick chart analysis, and even then you won't be set because there's a whole psychological aspect to it. But anyways, the average true range is very indicative of emotions, right? So when price is moving a lot up and down, shows that human emotions are really going off at that point. Like as I said, supply and demand. I'll continue to preach that over the next 3 weeks, but supply and demand is really the driving factor behind the price. It is literally the determination of the price. Yeah. So as I said, ATR helps determine your target price and the odds of a specific price movement after a specific time interval. Uh, so kind of what does the ATR really tell you? So if the price is already up substantially and like you don't know if you should enter that trade, but it's actually moved more than the average true range, so like the price volatility, it's moved past that. Um, it's likely not a good idea to buy in at that point. Why? Because if you're above the average, that kind of means that there's a low probability that it's going to go even further above the average, right? Because the average is literally like the middle point, not really the middle point, that's the median, but it's sort of yeah, I'll just say it is the midpoint of the prices during that time interval. And if you're going to go the higher and further away you get from the average, there's a less likelihood that target price is actually going to occur. Like as you know, like for a math example, the further away you move from the average or like more standard deviations you go past, there's a less likelihood or probability of that point actually occurring or that point in a data set actually occurring. So yeah, the price is more likely to fall if the price is higher than the ATR and stay within that price range if it's already established by the ATR. Because remember, the ATR is just an indication of volatility or price volatility. Sorry. So yeah, so just don't enter a trade if the average true range is higher than the share price at any given moment. Okay, so this kind of concludes our take on technical analysis. As you can see in the snippet, there's a lot of different technical analysis indicators. And all of these indicators are based on support and resistance of a price. So like how much is the price actually, or whether the price is going to go past the low previously or the high previously. That's kind of support and resistance. Like how much is it going to stay within a certain channel of price? Trends. So as we were mentioning, upwards trends and downwards trends. There's a lot of different technical analysis indicators for that. For momentum, like if once an uptrend starts, how likely is that uptrend going to continue to occur? And then there's volume. So volume is just the number of shares being traded at that specific amount of time. Volatility, how much is a price moving within that time? And then lastly, breadth. So studying all of these technical analysis indicators and sort of creating your own system, that will take a very long time. So one thing I want you all to be careful of is to not have solely an academic approach to finance or to trading and investing rather. You want to make sure that everything you learn is going to be interpreted into results. You can know everything about technical analysis, but be a very bad trader because as I said, the psychological aspect of trading is one of the most important parts of trading. So yeah, if you guys want to, you guys can actually go to Wikipedia. I mean, most people like teachers, if you guys were in a public school, then you'd realize that teachers always press against Wikipedia. Well, Wikipedia is actually a very good way to kind of see the connection between topics. And like, for the example of technical analysis, there's so many different parts of technical analysis that are necessary to know that it's very great to just see an aggregate like sort of list of everything that you need to know. This is not everything you need to know. You don't really need to know everything. Some people, including me, we just like to use moving averages, and that's just very indicative of good entry and exit points. And from there, it's fine, right? Like we can kind of get our own feel for how many shares we want to buy. But when we're just thinking about entry and exit, like that might be like some of the most important parts. But what you will find though is that position sizing, meaning how many shares you're buying or selling, is very important as well. So yeah, depending on what you're trying to think of, like sort of what you're trying to decide where to enter a trade or how many shares to buy during that trade, you will have to use different technical analysis indicators. So we're not going to go over all of these, obviously, because it's honestly a waste of time because a lot of these different technical analysis indicators, or actually all of them, were created by humans, right? These are based off of like human visualizations of patterns. They're computer programmed, but they were created by humans, meaning that they're not accurate. They're not 100% accurate or indicative of future price movements. So I would recommend all of you guys to just use moving average graphs and average true range graphs over the next week. not to place trades probably, but to just kind of visualize where it would have been great to enter a trade and whether the moving average graph was correct. Meaning, like, if the moving average graph intersected the candlestick graph at that specific point, how great would it have been if you bought in at that specific entry point? All right, so yeah, just studying all of these technical analysis indicators, you just want to, sorry, you want to make sure that your trading system or sort of the rules by which you trade by are consistent. If you keep changing up your system, like, oh, I'm going to use my moving average graph to determine my entry point, or oh no, never mind, I'm not going to use my moving up. I'm going to use a parabolic SAR. That's another one of the indicators here. You're kind of manipulating your strategy way too much. You don't really know after a certain amount of trades until you actually complete them whether your system is actually a very like strong one, or if it's very weak, meaning that it's very up in the air. So you want to make sure that your system maximizes earnings, and just based off of experience and based off of like the past 60 years, just paper trading, as in like using fake money, moving averages and average true ranges are very strong ways of sort of predicting price movements and basically the best entry and exit points. So yeah, just solely knowing whether the price is going to go up or down after a given moment, it's not really going to do much for you because you want to maximize your capital gains. So that's, as I said over and over again, the moving averages job. All right, so that concludes our lecture. We ended kind of early today, but overall next week we're going to go over finding more ways to find exit and entry price, and position sizing, meaning how many shares you want to buy or sell, creating your own trading system and rules, so you know which technical analysis indicators to use, and then also sort of how to overlap technical analysis, including candlestick patterns and graph indicators such as the moving average and ATR, with the market news, right? Because you always hear in the news like, oh, Elon Musk said this or that, and you know that's a very big movement of share price. Yeah, that can cause a very big movement in share price, or relatively big movement. But you know, how do you sort of combine technical analysis like for short-term trading on top of what you hear in the news? But what I went over in the first lecture is don't get too caught up with news. Everything in the news is old in terms of how important it is towards making your trading decisions. Because think about how much time it took for the reporter to write up the report and then upload it to, for example, CNBC, right? That probably took around at least like 20 minutes. And during that 20 minutes, the big Wall Street bankers, they already had access to that information, right? So those bankers, they already determined this the price, because the price